Dear investor, in this edition of Market Outlook, let us discuss the following. Quarter 2 result season aggregates and expectations for the next period. Last period was very eventful. We will discuss on that. Flows, FPI sales, domestics, etc. And of course, valuation and our belief that it continues to be time for alpha. On the first topic, quarter 2 result season and the expectations for the next period. Well, quarter 2 result season was overall weak. It was, in terms of growth, the weakest that we have seen over past several years. However, most of the large misses were in the commodity pack. This quarter was expected to be weak because of strong, monsoon intensity. For example, if on account of rains the weather is cooler, there is less air conditioning need, which would result in lower power demand and hence generation, and we will get a lower overall growth number. Similarly, higher rains in the open cast mining areas would impact mining activity and the output would be lower. So that was the reason to our mind. Now, happily, our choice of companies had a good result season overall. Most companies bet expectations. We believe the next period, we are hopeful for the next period. We believe the next period should see the benefit of strong monsoons in better purchasing power in rural India, and we should also see the benefit of restart of government spending. Hence, the outlook for second half is clearly better. Last period was eventful from the market point of view. The month of October had several events which took place one after the other. Chinese stimulus package was expected, and that resulted in very strong performance of the Chinese market, and there was a pull of FPI money away from various emerging markets into the Chinese market. However, the market performance and stimulus-induced inflows seem to have run its course. The stimulus is seen as below expectations, and some foreign brokerages have already brought out reports on the same. Next thing was increase in US bond yields that reverts the inflows received in September, as then the bond yields had fallen. Now, third was, of course, Trump emerging victorious in the elections. He has promised to make America great again. The proposed routes that he may take and its implications are as follows. One, there would be increased focus on manufacturing. Now, this would involve protecting American manufacturing against, let's say, China. He has spoken of higher than current import tariff barriers. Now, if you look at who has the most adverse trade balance with the US after China, Mexico is the next biggest source of trade deficit. There already is speculation that Chinese are rerouting their exports through Mexico. Trump has talked about a higher import duty on Mexican imports. Now, India has a surplus, but a small one, and our exports would mostly be taxed lower, as would probably be European exports. Now, the import duty differential would make Indian manufacturing more competitive in the US market, and we believe all of these changes should be positive. The next thing that is proposed is reduced taxation on the rich and the corporates. Now, this would help corporate profits immediately, and what then happens is the extra profits increase the scope for extra spending, as there are some savings. And the extra spending could go into tech services, which is positive for Indian IT. However, this implies that the fiscal would be stressed. We believe higher import duties would help address some of the stress, as it would be paid by US consumers. Now, American economy is nearly at full employment, and substitution of imports with American production will largely not occur except in strategically important industries. Next is higher duties. We believe it would be inflationary, and that implies higher bond yields, and bond yields have been moving up. Now, this lowers the chances of continued Fed rate cut, making US dollar stronger and thus increasing the flow of money back into the US. This is something which is negative EM capital markets. The next point is global peace and defense. Now, Trump has also said that he would resolve Russia-Ukraine and is backing Israel strongly. While peace is welcome, Russia-Ukraine peace would probably come at the cost of loss of around 20% of Ukrainian territory. This could keep military spending high for near and even mid-period future. A resolution may work in favor of Indian defense companies as they start to get components from America, for example, engines for Tejas aeroplanes, and Israel, and also Russia, stuff that is stuck for conflicts in that region. Now, Trump also wants Europe and rest of the world to shoulder a larger part of overall defense spend and not depend on implicit US protection guarantee. This again is positive defense spending. The next point is Trump wants to tweak Inflation Reduction Act, IRA. While IRA is often thought to be an act for supporting green energy, its aim is broader and more sweeping. It aims to reduce the fiscal government budget deficit, lower prescription drug prices, and invest in domestic energy production while promoting clean energy. However, IRA is not the only measure, it is the last of a series of measures taken to promote renewable energies. While this may be tweaked, there are others which will come into effect, is what our sense is. And moreover, southern sunny states aligned with renewables are where Trump has done well. Solar here is already competitive versus other sources of energy, and there are plans to scale it up rapidly. Musk, who has a large influence in the new dispensation, believes that most of the power in the future would be solar driven. Now, overall impact is as under. US equity markets look much more attractive as corporate earnings would get buffeted given import duty protection increases and corporate taxes cut. Higher bond yields could make inflows into EMs negative. We have seen that for several days now. Policy focus away from China implies China loses money. China being a large part of EM basket, the basket loses money, resulting in further continued selling pressure on EMs. So continuous FPI selling is something that we expect in the near term. Fundamentally, India is expected to benefit. However, it could also see FPI selling on the back of EM fund outflows. Now, focus on defense globally would increase. The current move away from EMs into the US, should be seen as a short-term reaction to a longer-term trend. The longer term, on account of a large US debt stock, high continuing fiscal deficit, diversification of country reserves away from the USD, on global geopolitics, possible slowing of bond repurchase by the Fed might all result in gradual weakening of the USD versus other currencies. In this context, while investors and investment managers are taking money to the US tactically in response to whatever Trump has said, the bulk of the money invested into other regions may be retained. We expect it to be retained as investors would want diversification benefits. Now, while US is amongst the best performing global markets, India is also amongst the best performing global market. It is cheaper than the US on valuations on many counts and has depth to allow large sums of money to be invested and now also taken out. We have proved that with the selling that we encountered in October. While FPI selling pressure is high, it is showing signs of reduction. We believe that FPI selling pressure below rupees 3,000 crores on a daily basis can still allow the market to perform in a normal manner on account of strong domestic flows. Now, domestics are buying, FPI sales may continue to be strong, as is the supply of paper. while domestic investors continue to pour money into the mutual fund industry, and that has sustained buying by domestic institutions. Domestic investors continue to build equity allocations into their portfolios through SIPs and are taking advantage of market corrections. Net flows into MFs were stronger in the month of October versus the usual trend. So, buy on dips seem to be the flavor of the day for domestic investors. Now, FPI selling has continued while October saw a record sell-off. Mid and small caps have weathered the storm better. People think that when markets are down, mid and smalls fall more this time, and most of the times after 2020, the experience has been different. Mids and smalls have withstood the storm much better. November, yes, has seen lots of mid cap and small cap sell off. So let's see how it ends. Now, supply of paper continues to be high. While the peak monthly supply is probably behind us as large IPOs of Swiggy and Hyundai are concluded. Now, supply of paper is taking some steam away from the equity markets. Fund raised through QIPs though may continue to be strong. Fund raised by corporates fuel economic growth and we believe act as a pressure wall for the markets, allowing for orderly discovery of valuations, and we welcome this. Now coming down to valuations. With the market correction, valuations have corrected. Markets have been at the same level now for 6 months, and in the process we believe valuations have been corrected by 6%. In the same period, US market has continued to remain strong. So resulted in US market now trading at a premium to the Indian market on some valuation parameters. So relatively we are looking better now. We continue to think that Indian market valuations were sustainable and are now more sustainable. Outlook going forward for earnings is better versus the first half as government spending restarts and benefit of a good monsoon percolates down and volatility associated with the regime change in the US settles. We believe it continues to be time for alpha. Now, change of guard in the US could have a positive impact on two largest spaces in the country, indices, banks and software. Banks would now get to enjoy, to our thinking, higher bond yields for longer, and the pressure on NIMs may reduce. Software services, in the first round of Trump got impacted by lower H1B visa issuances, but this time around the industry is de-risked by having more on-site personnel, reducing the need for H1B. While the risk is lower, the business may get a positive tailwind from lower taxation-enabled spending as we noted before. Hence, the regime change is overall a positive for Indian market indices. At the same time, higher bond yields are sustaining in the US and resulting in a large FPI sell-off, and to some extent that is now impacting the mid and small part of the market also. If we look at our holding companies, most of them have delivered strong numbers in Q2 and have a positive growth outlook. We continue to believe in longevity of growth in spaces like new tech, renewables, electronics, luxury consumption, capital markets, mid-cap IT, etc. and are using the downtick to build positions in these spaces. We believe that while the index may do relatively better as banks and IT find feet, the earnings growth differential in our part of the market is high enough, and over time the bank would reward higher sustainable earnings growth, just like the market did with software companies in the 90s when they were delivering strong growth. So mostly we are staying put in our portfolio construct, while we are also saying the index, with software and banks have a slightly better outlook than before. With this, thank you, happy investing, and may the good times continue.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.